Hello friends. In today's video, I want to share my views on Bank of Nova Scotia, a Canadian banking stock which pays a massive and reliable dividend and can also be considered as a solid stock to buy and hold for the very long term. Bank of Nova Scotia, or more commonly known as Scotia Bank, trades both on the Canadian and US stock exchanges under the ticker symbol BNS. If you are from Canada, it may be preferable to buy the stock traded on the Canadian exchange, as it may be more beneficial from a taxation perspective depending on your individual circumstances. So Bank of Nova Scotia is one of the big 5 Canadian banks, along with Royal Bank of Canada, TD Bank, Bank of Montreal, and CIBC. It has a super long history, founded in 1832, and it is arguably one of the best diversified banks in Canada, with operations substantially weighted to Canada, where the financial regulations are quite strong, but also having sufficient exposure to the US, Caribbean, Latin American, and other international markets. The breakdown of the total assets under management as at the end of fiscal year 2019 can be seen in this chart. As you can see, Canada accounts for 58% of the assets managed, and the rest is spread across the other markets. Here is a snippet from their corporate website, which will help us understand a bit more about their operations. As you can see, they are one of the leading banks in the region and manage over $1.2 trillion in assets, and their workforce consists of around 97,000 employees. Their operations consists of 4 core segments: Canadian banking, international banking, global wealth management, and global banking and markets. Their Canadian banking operations are serviced through a network of 953 branches and over 3,600 ABMs, and they offer services to both the retail and small business clients as well as full suite commercial banking services. Their international banking operations is similarly conducted via a network of over 1,900 branches and 60,000 employees. The international banking operations is focused on the Latin American and Caribbean regions. Their global wealth management segment is structured to deliver wealth management solutions to their clients, and this service is available across 14 countries worldwide. Finally, their global banking and markets segment conducts the bank's wholesale banking and capital market business with corporate, government, and institutional investor clients. With regard to their recent financial performance, the 2020 Q3 results are due on August 25th. So for now, we will look at the Q2 results to understand how the bank has been performing recently. Their fiscal year ends on October 31st, so Q2 is the period February 1st to April 30th, 2020. As you may have expected, they indeed were severely impacted by the current global situation, and their overall earnings per share dropped 39% year over year and 43% quarter over quarter. As you can see, their revenues though is up 4% year over year, so some of the weakness in the earnings can be attributed to the huge provision for credit losses that they have to make as per regulatory requirements to cover for potential losses that could arise from client defaults. Overall, the current situation for the financial sector doesn't look good, but I believe this is just an interim situation and things will get back to normal once the global economy opens up again. Moving on to their financial health, as you can see here, they are adequately funded and have sufficient liquidity to tide over the current global economic situation. They are well covered from a CET1 and LCR requirement perspective, and for those of you who are interested in learning more, I have displayed here what these terms mean at a high level. As for their stock price, again it is obvious that the stock is off its highs, just like most of the other banks in the US and Canada, and the stock is down over 25% from their 52-week high of 76 Canadian dollars to $57.03 where they are currently trading. You can also see here the chart of the stock trading in US dollars, and it will pretty much tell the same story. The current situation in my view is a great opportunity to acquire some shares and ride it out for the very long term, as this bank is likely not going anywhere for the following reasons. 1. They are a well-established player with nearly 200 years of operations. 2. The Canadian banking sector is one of the most tightly regulated ones in the world, so their funding situation would be closely regulated and supported for any weaknesses that may lie ahead. and 3, their dividend payout ratio is around 58%, so the 6.3 current dividend is very well covered even with the recent drop in their earnings. If anything, this is a great buy just for the dividend yield alone, as their 5-year average dividend yield was only 4.5% compared to the current 6.3%, and once the economic situation settles down, it is quite likely that more investors would flock into the stock to take advantage of the rich dividend yield. And as you can see here, their price to earnings ratio as well as the price to book ratio are also lower in comparison to their 5-year averages, so these are also some more indicators of the fair valuation at which the stock is currently trading. One thing to note though is the chance that the current economic weakness becomes much more prolonged and we spiral into some sort of a recession. This would obviously not be a good thing for the financial sector in general, so it is definitely possible that this stock could crash more, and if you're thinking about buying this stock, the focus should be on holding it over the long term, and it would also be good to buy in smaller portions to take advantage of better prices if and when the stock drops further. Personally, I am quite happy to buy Canadian banking stocks with up to 5% of my total portfolio, so I plan to buy some shares now at the current price and also sell one $35 put option expiring in December 2020, which should give me about a 75-cent premium. This would equate to a 6.3% annualized yield, which I will be happy to collect while accepting the risk of holding the stock for the long term in case the stock does fall below the $35 mark at the expiry of the put option. One thing to note here is that this put option is on the stock traded in the US market, so you could look up the Canadian option chain in case you are from Canada and prefer to trade options in this market. However, the Canadian options market is also pretty thinly traded, so the premiums and liquidity on offer may not be as rich as the US market. And as a friendly disclaimer, please note that I am not a licensed investment advisor and my videos are only meant to document my views on various investment related topics that I am interested in. So please consult with your own investment advisor before making any investment decisions. Hope you enjoyed this video, and if you found the information useful, I would really appreciate if you can please leave a like and comment below and subscribe to my channel. Have a great day, and I'll see you in the next video.